Welcome to your Monday Mortgage and Market Update. Today we're answering the biggest questions buyers and sellers are asking in 2026. Where are the mortgage rates? Why is inventory still tight? And where opportunity actually exists, nationally and right here in Tampa and Dover. As of early February 2026, the average 30-year fixed-rate mortgage sits just above 6%, typically between 6.1 and 6.3% depending on the lender. 1 year ago, rates were near 7%, meaning affordability has improved, even if it doesn't feel dramatic. The 15-year fix is closer to 5.5%, and rates are stabilizing along the 10-year Treasury around 4.2%. Rates are no longer skyrocketing, but they're not returning to pandemic lows either. Why did mortgage rates fall and then bounce? One of the most misunderstood drivers of the recent rate movement wasn't the Federal Reserve, it was the bond market. In early January, rumors that the federal government could purchase $200 billion in mortgage-backed securities briefly pushed rates to their lowest level since 2022. Mortgage-backed securities provide liquidity. When lenders know there are guaranteed buyers, they can offer lower rates. But without sustained buying, those gains faded. Rates can dip, but without structural support, drops are often temporary. Mortgage applications recently fell 8.5% week over week. Refinances dropped 16%. Why? Because nearly 69% of homeowners have mortgage rates under 5%, and more than half are under 4%. This creates what's called the rate lock effect. Fewer listings, tight inventory, and buyers competing for quality homes. But what actually unlocks inventory? Lower rates help, but they're not the master key. Inventory unlocks through assumable FHA, VA, and USDA mortgages, creative seller financing and buydowns, tax portability and potential Florida property tax reform, downsizing, mobility needs, and life events, price stability, not price growth. The real unlock is restoring mobility without punishment. Now for our local market spotlight. First, Tampa 33629. South Tampa remains one of the most premium submarkets in the region, with months of supply at 5 months and a median sold price of $934,620, with a median days on market of just 16 days. Prices softened, but demand didn't collapse. Homes are actually selling faster when they're priced correctly. This market rewards prepared buyers and strategic sellers. Now for Dover. Dover tells a very different story. The months of supply is 4.41. The median days on market are 106. Inventory is up 22% year over year. This is a negotiation-friendly market with time, options, and leverage for buyers. The Dover takeaway: if land, space, and flexibility matter, Dover offers breathing room. Tampa just doesn't. The housing market isn't frozen. It's selective. Tampa rewards decisiveness. Dover rewards patience. The biggest mistake right now isn't buying or selling. It's waiting for a market that no longer exists. If you understand where leverage lives, opportunity is still very real. Subscribe for weekly Monday mortgage and market updates and drop a comment if you want a breakdown of your specific neighborhood. I'll see you on the next video.